second quarter of 2019 was an unusual one. Despite a sell-off in May, the quarter ended with Wall Street reaching new all-time highs, pulling the MSCI World Index of Developed Markets also to new highs. But the most dramatic moves were in bonds, where interest rate expectations have been repriced substantially lower in the face of weakening growth, falling inflation, and rising deflationary fears. Yields on 10-year US Treasuries fell by 40 basis points in quarter two to 2%, taking the fall in yield to 70 basis points this year, and other government bond market followed. In many major economies, yields have fallen to all-time lows. In Germany, 10-year yields are minus 40 basis points for the first time ever, dropping below the ECB's deposit rate, with positive yields available only on maturities above 20 years. These are extraordinary moves given how low rates already were at the beginning of the year and have resulted in exceptional performance from bonds. Global government bonds returned 3.5% in quarter two and 5.4% year to date, while in credit, corporate, high yield and emerging market bonds all produced good returns in quarter two and of 10% or more so far this year. A 2% yield from govies may not sound like much, but now there is $13 trillion of bonds trading at negative yields worldwide. For the quarter, the US and world markets returned 4%, taking year-to-date returns to 18% and 17% respectively. In remarkably benign conditions, with nearly all asset classes up, it was notable that safe haven assets also performed well. Gold was up 9% in quarter two and the Japanese yen up by close to 3%. In part, this might reflect the growing uncertainty about the state of the global economy and geopolitics, and in part, the longer-term implications of the truly extraordinary conditions in bond markets. President Trump continues to provide noise and unpredictability, but it was unquestionably the shift to much more dovish positions by the Fed and the ECB which was the driving force behind markets. Central banks are reacting to two critical developments. First, increasing evidence of a slowdown in growth, and second, a fall in inflation and perhaps more importantly, inflation expectations. The slowdown in growth has to date been largely in manufacturing, with global trade hit by the US-China trade war and the key auto industry facing unprecedented disruption and falling sales. Manufacturing is in recession in Europe and slowing sharply elsewhere, and leading indicators point to a continuing tough environment. Today, the consumer and service sectors have held up well, but there have been signs recently that confidence is waning, increasing worries that a soft patch triggered by the downturn in manufacturing could become more widespread. The drop in inflation highlights the problem that central banks face. After a decade of ultra-loose policy, inflation in most developed countries remains below central bank targets. Indeed, inflation in the US, Europe and Japan has remained stubbornly below target rates throughout this post-crisis period, despite the efforts of central banks to push it higher with unprecedented monetary largesse, and the spectre of deflation remains a worry in the Eurozone and Japan. Despite the strong returns this year and the powerful support to valuations from low inflation and exceptionally low interest rates, uncertainty remains high. Aside from the slowdown in growth, the unfolding trade wars and the negative impact on corporate earnings, other concerns, each with the potential to damage confidence and growth and to disrupt markets, continue to worry investors. Some caution then is warranted in the short term. Equity and bond markets have risen sharply this year, driven by the prospect of easier financial conditions, and valuations have become stretched in some areas, notably in fixed income. Yet the economic backdrop has deteriorated a little. Corporate earnings are under pressure, especially in sectors most exposed to manufacturing, and markets are largely discounting sizable policy easing by central banks in coming months. However, while trade and manufacturing have been weak, the key service sector has remained firm. Employment has been strong and the consumer is generally in good shape. There are no signs of systemic financial problems and an ensuing liquidity crunch, or of capacity shortages, inflation and a sudden tightening of policy. With inflation subdued, central banks have considerable flexibility in keeping policy ultra loose for much longer, thereby extending this extraordinary cycle. Furthermore, the extent of the falls in the government bond yields and the impact on financial conditions and valuations of other markets should not be underestimated. US bond yields have fallen by over 100 basis points since late 2018. This provides a strong underpinning to equities and other risk assets, offsetting the more challenging conditions faced by the corporate sector after last year's benign backdrop. While some consolidation is probably overdue, we do believe the cycle has further to run, and any falls in markets will give rise to opportunities to add to risk assets, while at all times maintaining careful diversification in portfolios to provide protection during inevitable short-term setbacks.
The Momentum Global Cautious Fund has returned 4% per annum over the past 3 years, net of all fees. That's referring to the A-share class, which most of our investors use. For comparison, an investment in short-term cash would return less than 1% per annum, approximately 75 basis points, depending on which currency you're looking at, while global bonds have returned 1.6%. Hence, 4% is a reasonable return. Relative to peers, that places us in the second quartile in this fund, which again is a reasonable outcome. To recap, we've set these funds, Cautious, Managed and Growth, targets about outperforming cash by 2.5% to 5.5%. So investors know their money's working materially harder for them than it were left in the bank. It's pleased to note that we've delivered on these targets as at June 2019. When we look back at the 11-year history of these funds, the Momentum Global Cautious Fund has delivered on its target approximately 75% of the time. In the case of Managed, this figure is about 90%, and then Growth, the growth funds have met or exceeded its target on every occasion. Again, with reference to the opportunity set of professionally managed funds in South Africa and investors have to choose from, all 3 funds remain first and second quartile over 3 and 5 years. Over the latest quarter then, the funds returned 2.6%, 2.5%, 2.4%. These are good returns in absolute terms, considering it's 3 months, and reasonable returns relative to equities, which returned slightly higher, 3.5%. Our gold position performed well, with the gold price rallying 9%, and also our bias to equities over property, with the former equities outperforming listed property by around 3% over the quarter. The key detractor was managed selection within equities. Equity managed selection has been a detractor over 12 months, along with regional positioning within equity and our bias towards EMEA and away from the US stock market. James will have touched on this in previous videos, and I've written several communications on the topic. Critically, we expect both of these themes to reverse, and we've not locked in significant amounts of underperformance as a result through turning the portfolio over unnecessarily. In conclusion then, it's been a good quarter and it contributes to the strong longer-term performance of these strategies. We look around the world for the best investment specialists within each specific asset class, whether that's US smaller companies or emerging market debt, for example. This includes passive strategies where their fee justifies the lack of alpha potential in what may be highly efficient markets. Global equity markets have performed strongly this year. Underlying company earnings have not kept pace, with the result that valuations, and here we can consider oft-used measures like price to earnings ratio, have increased. However, the equity risk premium, what we stand to earn over and above cash and bonds, is still reasonable, and as a result, we retain a reasonable allocation to global equities in the funds with a bias towards EMEA, where pricing is less aggressive currently. Within equities, we continue to like the profile of listed infrastructure, and our preferred manager, Maple Brown Abbott, has performed reasonably well thus far in 2019. We have a lower exposure again within equities, some of the technology names that have run the hardest, and a higher exposure to some of those areas that have been underperforming recently. For example, retail, very selectively chosen obviously, and energy. We remain underweight government bonds where yields are unattractive. Where we do own government bonds, we remain heavily biased to the US, where there's scope for yields to move lower, unlike in other markets. We also have an allocation to inflation-linked bonds, given that markets are currently disregarding the chance of any inflation for the foreseeable future. We think this carries a low, but nonetheless higher attendant probability than the rest of the market, and hence these securities are inexpensive. We think the opportunity in short duration high yield, short duration emerging market debt and loans remains attractive. To that end, we participate in the latest capital raised by Sequoia, a specialist funder of infrastructure projects, predominantly in Europe and the US. We also retain an allocation to gold, which looks fair value in inflation adjusted terms and relative to real asset prices, given it offers a key hedge against, well, in consideration of the extraordinary monetary policy that we see today.